Hello, my name is Kirill Perelyguine. I'm a commercial real estate broker with Royal LePage Real Estate Services in Toronto. Welcome to my video blog dedicated to commercial real estate. Today, I would like to discuss some of the aspects associated with the CMHC financing. CMHC is a Canadian mortgage and housing corporation that insures and provides financing for certain types of the properties. And my guest today will help me to describe those properties and show me a couple examples of how it's done. So I would like to welcome commercial mortgage broker Daniela Peeva.
Thank you, Kirill, for having me as a guest. I'm very honored. My name is Daniela Peeva, and I am a VP of commercial mortgages in Mortgage Alliance Commercial Ontario. I've been doing commercial mortgages and specializing strictly in apartment building financing for about 3 years. Prior to that, I am a graduate lawyer that used to do banking law.
Okay. Thank you, Daniela. I really appreciate you joining me. So let's just start by maybe describing what is the CMHC financing? What does the Canada Mortgage and Housing Corporation provide different from conventional financing?
So CMHC, it's a mortgage loan insurance product. CMHC on the commercial side is the only provider in Canada for mortgage loan insurances for either construction, purchases, refinancing on small scale and large multi-unit residential properties. The smaller one that they will start financing will be 5 units, so 5 units and up. CMHC offers both funding opportunities with their own sources and funds, and also acts as a mortgage loan insurance product to support the construction, purchases, and refinancing. The rental properties that they support are multi-unit residential, affordable housing, retirement housing, student housing. They're due first, second mortgages, and pari passu mortgages.
Okay. So technically, from a buyer's perspective, why go with CMHC comparing to conventional? Like, why don't they just I know that there are fees involved. There is the process is lengthier, from what I hear.
You're absolutely right. There's a lot of misconception on the market that CMHC mortgage insurance product is very expensive. You're paying high premium. However, the benefits of having this product are tremendous. First, you get preferred interest rate. This is typically 1% lesser than the standard conventional pricing. For example, a conventional funds for apartment building as of today will be close to 3.25, while CMHC, having CMHC financing will provide you or give you access to funds that are below 2% mark. In my last deal, I was quoted 1.73% for a loan amount of 1.6 million. 30 years amortization, 5-year term. You cannot get that on the conventional side. So the biggest benefit would be preferential interest rates. Also on the CMHC insurance side, you can get up to 85% of the value of the property, of the lending value. Of course, the lending value is different from the purchase price, but having an 85% financing on a very stabilized and market value property, it's rich. It's quite impossible to get it from the conventional side because they're usually restricted to 70 or 75%. In some situations, 65, depends which lender in the conventional side you're using. Mm-hmm. To add to that benefit also is the big amortization period or the extended amortization period the borrowers are able to get when they have CMHC insurance product. The 30 years amortization period is available to most apartment building properties. The only requirement would be that the life expectancy of the building is over 30 years and you can qualify for the amortization of 30 years. There is 35 years available for property that are 5 years or less in terms of being built 5 years or less, or recently renovated, and 40 years amortization is available for brand new buildings. So that's a huge difference and makes a tremendous change on the net operating income and debt service coverage when you receive when you're applying your analysis on the pro forma. Getting a higher amortization period and a low interest rate really changes the cash flow for the borrower. So it's a great advantage. In some situations, there might be a non-recourse considered if the loan to value is less than 65%. Again, that's very hard to get in the conventional side. And also personal guarantee can vary from 40% to 100%. So there's a lot of benefits to it. And in our recent crisis, a lot of borrowers have been worrying about what would happen if the values of the property fall down, and would the lender call the loan if we have extended mortgage. So if you have the CMHC product, you would never be worried about that because your mortgage is insured, your loan is insured for the entire term of 30 years. So it doesn't matter where the market is, you will be secured, and the lender will not be able to call the loan.
That's great. It's really a win-win situation, and you have to come up with less funds for the down payment, for the deposit, and you have a better cash flow. Of course, it should be.
I don't want to put the misperception there that you really need less money for the down payment. This is the case, though, for properties that have market rents and their gross income and complete revenue is based on the market rent. This will be the scenario, but a lot of the apartment buildings, especially in the GTA area and in Ontario, we see that the revenues are not really market revenues. They are the leases that the tenants are paying are very outdated, and they're paying the revenues. It's significantly lower than what it would be if it's a market revenue. So we don't determine the down payment based on the market value.
I understand. Okay, but on the same side, from the CMHC perspective, I have researched that like a couple of years ago in a certain area, and the I guess it was for the affordable housing, the rents that the CMHC has in their table are usually lower than the market rate. So
I would agree with you that if you were to submit a file to CMHC, let them drive the show and let them determine the actual market rates, or you don't correspond with them and explain to them why your property is different, your loan can be significantly cut back. So this is the onus on the people or in the process who is submitting your application. To put it into perspective, if you're submitting an application, your rents are extremely higher than what the market rents are, and you have no explanation, the CMHC will cut them back right away. And if your reply is okay, that's where it ends. Okay. However, if you submit to CMHC and explain, okay, the reason why my market rents are because of A, B, C, and here's your supporting documents, similar building down the road, these are achievable rents, and here's a report from my realtor who can support these rents in the current market, they wouldn't even come back with asking questions. Rather, they'll accept your market tenancy agreements and will apply these revenues to the actual revenues, and they won't question it. So it really depends on how you're submitting it and what justification you're giving to a CMHC.
Okay, great. So I guess let's talk about the process more. Let's say I want to buy a building, and what do I start with? Do I get all the paperwork in order? Do I need to hire an appraisal, or is that going to be the CMHC who's going to be giving me a list of the appraisals who work in this area? How does it work?
Okay, so CMHC does not work directly with borrowers. CMHC only works with lenders and few CMHC approved brokers. There's only 5 that I know of across Canada. So the options for you to get that product is going directly to the lenders that support CMHC financing or going to CMHC correspondent mortgage broker. The process usually is the broker or the lender will collect your entire information, including detailed rent roll, detailed expense statements, the bills for the last 12 months. If the property is 5 or 6 units, you do need an appraisal. But if the property is over 7 or more units, you do not need an appraisal. You need environmental in every single case. You have to provide the actual cost, the current rent roll, and in some situations they might ask for the leases. If you have a commercial component, the commercial component cannot exceed 30% of the actual building, or you're not going to qualify. But if you do have a commercial component, the commercial component of residential income are separately underwritten and then joined together. So you have to provide the actual leases for every commercial tenant. Once the entire information is collected, the lender or the broker will apply directly to CMHC and pay an application fee of $150 per unit. And then CMHC picks up the file, it allocates a case number, and in today's market, it takes 2 to 3 weeks for CMHC to provide the COI. The reason why they're so quick is A, the inspections that they usually do is no longer happening. They're not sending inspectors on the physical property, and B, they have really hired and stepped up sometime in November a lot of people and really helping the market in these difficult times. So the timing has tremendously improved with the CMHC application. So in the 3 weeks, when an analysis picks up the file, he can cut back the loan, he can give you feedback, he can ask more questions, or he can simply recommend for issuance of certificate of insurance. Everything is going to depend on the way you represent the file and how you have justified your numbers. So it's very important to trust the person that you're working with, that will spend the time and will be on your side to get you the maximum loan possible, or to argue the higher economic value. Once the COI is issued, then if you have gone through the lender will issue either the commitment letter or the LOI, and then we'll proceed with the lawyers to close the file.
So how long would you recommend me as a broker to put due diligence or financing condition for the loan? How long should it be?
So I always recommend that the borrowers get at least 2 months, which is 8 weeks for due diligence on the financing aspect. And whether the 8 weeks will be sufficient to close the deal, it's in the air. I don't know. It really depends who the lender is and who the lender most likely is working as a legal company or legal advisor, because that's where really the file slows down today, because we don't have an appraisal for most cases, or even if you do the appraisals, are pretty quick. At least I find the appraisals are pretty quick in this market. The environmental specialists, they're quite speedy. So it becomes as the lawyer, how quickly the lawyer on the lender side will be able to close that deal. So that's where the delays might happen.
Okay, I see. Thank you very much. So why people should use CMHC? I understand you have an example that you can share with the life difference of one case versus the other, and if you can just elaborate on that.
Yes, before we go to the example, I want to, because I forgot to mention the different criteria in how CMHC underwrites the files. So usually CMHC will apply the actual cost for the property taxes, the utilities, the insurance, if there's elevator costs. So these taxes are the actual costs, and you have to provide 12 months bills in order to justify them. Above and beyond that, they have certain guidelines that they apply, and it's a benchmark of expenses where it's going to be within a certain amount for particular properties. And just to make it easy for everyone, I'll share the Ontario benchmarks. As of January 2015, there is not a lot that have changed since that period of time. Kirill, can you please confirm that you can see my screen?
Yes, I can see your screen. Yeah.
Okay, so if we look at for a second for 5 or 6 units wooden brick structure, you see the repairs and maintenance that are recommended, or the minimum repair and maintenance that have to be applied for CMHC will be 600 per unit. There is a lot of room here to maneuver, in the sense that if I'm a lender, I want to be really a little bit more conservative. Or if I know that the property requires significant capex going forward, I won't apply 600. I have to apply 700, 750, 800. So there is a level of experience here that applies when you're doing that analysis. The salaries typically are 125 a unit. You can, in most cases, apply that standard number, and then the management admin fee will be the 3% of the UGI. Where your experience really comes into question is when you're underwriting 7 or more or bigger type of properties, because the cash flow really changes and the NOI really changes on the lender perspective and the CMHC perspective when you apply maintenance of 750 versus 900 or 1200. So lenders tend to be a little bit more conservative because they have investors to reply to, and they have to stay either in the middle or a little bit on the right side, with a little bit more expensive on the benchmarks. So if you're applying, for example, as an investor, 750 for maintenance and repair, and you think that that's going to be a fair analysis, you have to really justify it. Why 750? Oh, because I changed the roof. I have made a major capex on the windows, on the balconies, on the boiler. Okay, that makes sense. But this has to go in the analysis. You have to prove it if you're using the lower spectrum of the scale on the maintenance or any of the operating expenses. There is a big difference between, are we analyzing and we are underwriting for wooden brick structure versus concrete. For a lot of people, this is a surprise. But for us, it's really the norm. Concrete structure is very durable, but if something breaks, it's very costly to actually maintain. So if you can see the concrete structure, the salary jumped to 400, the maintenance increases with $100 as a minimum benchmark per unit. So it's important to know the benchmarks for CMHC operating expenses, as well as knowing where to go and where to check what vacancy CMHC are going to use. Because a lot of brokers I've seen, they apply different vacancies, and I'm not sure where they're getting that zero vacancy for a property. There's no such thing as zero vacancy. Even if the market has a sustainable track record of 2 or 3 years with 0.1% vacancy, CMHC will stick between 2 and 3. So you have to apply these important analysis in your pro forma. So to go back to your question of why the client should be paying the premium and what is the difference in terms of cost between conventional and CMHC, I will share the example that I have prepared for you. Are you able to see the other
Yes,
screen?
I can see it. Thank you.
Okay, great. Okay, so here I have taken an analysis for a 32 unit property. I just picked an area, let's say Oakville, and I have applied a projected rent. Let's say the annual projected rent for 32 units is 554,891,000. I've applied auxiliary income as parking and laundry. I've supported 3% vacancy for the property and have gotten gross income. Here, the property taxes, utilities, insurance are the actual cost of the building, and the rest have been underwritten in somewhere mid-range of the general expenses, so it can stay consistent. There's not much difference in the way you underwrite for conventional lender or CMHC lender. The costs for underwriting are similar. The only difference that it could be is that the actual contract for, sorry, I have provided here for two management fees, that has to be a structural reserve. My bad, it has been a long day. The only difference, as I mentioned, will be, let's say you have a management contract and you're not at 4%. You're at 6%. So the conventional lender will actually apply the 6% management fee contract. That is the one difference that I can think of right now between conventional and CMHC underwriting for the standard operating expenses. So and this is the conventional analysis. In the conventional analysis, we have to apply amortization for 25 years because that's the maximum. The current interest rate is around 3 to 3.25. Yep. I've taken it a little bit of the conservative way of 3.29. So the maximum loan amount for about 1.2 debt service coverage, because some conventional lenders will accept 1.2, others will accept 1.3. Let's stay in the middle. It's around 4.8 million. On the CMHC, the pro-forma changes drastically because, as you can see, the net operating income it's the same. It's 354,507, 354,507. However, when you apply 30 years amortization and you do apply about 1.09% interest rate lower, because if I'm closing this deal today, it's probably even lower than 2%, but let's give a little bit of buffer, 30 basis points, the loan amount increases with 1.1 million that the borrower can take on the financing. So you're increasing your loan amount by 1.1 million. That means you are actually taking away from the property a higher loan amount. So that's a very that is very compelling reason for a lot of borrowers to prefer the CMHC route. First, because they get more money up front, and also if you take a look at the cash flow after the debt service coverage, on the CMHC side, you get a cash flow of 82,464, while on the conventional side is less than that, 73,000. So not only you're getting more money every single month on the cash flow, you're also getting 1.1 million more on the refinance and the purchase. What is the cost? That's the big question. So I have done an analysis with adding the cost for the interest paid for the conventional and CMHC for 5 years and then 10 years. So all the numbers are identical at what I just showed in terms of the performance. On the conventional side, you're getting 4.8. On the CMHC, you're getting 5.9. 25 years versus this should be 30 years. Sorry about that. That's 30 years amortization, 5-year term for both. With conventional, you have the cost of appraisal, environmental, usually lender fee for the most part. On the CMHC, if you're working with a broker, you waive the lender fees. They might be there, they might not be. I have eliminated them just for the sake of the example. You have good and condition report on the convention side. You don't have that with CMHC because CMHC does their own analysis. But you do have the application fee of 4,000, or in this situation, 4,800, which is 150 per unit. And also, I have added a premium for below 75% loan to value at 2.5%. So every time you increase the value, your premium increases. But for this example, we'll stick with under 75%.
That adapts to the overall mortgage amount. Yes.
So the premium is added to the mortgage. So you're going to get 5.9 plus. You're going to be added 147,500 for the premium on top of it. So the building pays for the premium. You don't pay anything up front. Yeah. So it's great. The interest for 5 years on the conventional side, as the interest is quite higher, it's 769,460, while the interest paid for 5 years on the CMHC is 635,000. The overall cost is about the same. Yep. For 5 years. However, you get to pocket more money on monthly, and you get 1.1 million more in your pocket. Why wouldn't you go with CMHC? The premium, when you add it, yeah, I just don't understand a lot of people, I guess. I mean, the premium added is paid with the building. You still have the benefit of the cash flow. So I have done just for the sake, the interest paid for 6 to 10 years. So the interest paid for 6 to 10 years on the conventional side, if you're doing a 10-year term, will be 750. On the CMHC, your cost of borrowing drops with about 200,000 if you're doing a 10-year term.
No, it's amazing. It's really like it's showing right there. Basically, it's a great example. And Daniela, thank you very much. This is really amazing. And like after that, like I don't know why go with the conventional mortgage.
was it convincing? No, yeah. But there is a reason why a lot of the REITs and most borrowers, when they have a stabilized property, they go to the CMHC route without even thinking twice. I understand borrowers not going to CMHC route when your property is not stabilized, when the rents are very low, when you're going through major capex expenses for you renovating, you're bringing the expenses down. I get it. At that point, you probably need a bridge financing just to support this year, 2, 3 years of changing the property. But as soon as your property is stabilized, there's no better option.
And I understand that CMHC also finances construction of new housing. It has to be affordable housing?
Okay, so CMHC have few construction program. They have the affordable housing construction program, and they have the standard programs for the standard rental housing or student housing. So the way the affordable housing program works is the government provided $2 billion for funding that opportunity. So CMHC does not really act as an insurance provider, but they act as a lender. They lend their own money, the government money, for the affordable housing program. That program is available to support the cost of construction up to 100% financing on loan to cost for projects that are approved. In order to get your project approved, the two main qualifiers are that the property has to be within a very close proximity of public transportation and in an area where the vacancy is below 2%, so very desirable area. It is on case-by-case basis. So the CMHC will take the application, will underwrite it, and you'll be competing not only with the projects in the area you're submitting, but entire Canada in order to get that financing. So it's quite tough to get the financing, but not impossible. We've worked in a few files that we have applied and been successful with submitting for 95 to 100% financing. As long as you understand how it works, and you also get to understand the fact that it's not an easy program. It will take time, at least 8 months, in order to get approved. And you add all the affordability component in the loss of income, and you're okay with the entire process. It's an amazing program if you can qualify, because the rate right now will be close to nothing. Like if you can secure a product of the affordable CMHC housing, you'll be looking at a little bit north of 1% on a construction for 10 years. And your premium is waived, so you don't actually pay any premium because it's their own funds. So it's tremendously good program.
Wow. Thank you, Daniela. It's like it's really eye-opening, and I understand that for a lot of investors, a lot of buyers, that's going to be a good opportunity to explore while looking for a financing. And I understand that your company is one of the registered with the CMHC. You're fully, I would say, licensed to work with this program.
Yes. Yes, we are one of the few brokerage in Canada. I am very fortunate to work for We've been nominated 7 years in a row for the top commercial brokerage in Canada because of the relationship we have and the fact that we're sustainable. We've been in the market for over 15 years doing nothing but commercial mortgages. I don't even know how to spell residential. I've never done a residential deal in my life. So I'll need some help if I need financing on my own home.
Okay.
So it is something that we really specialize in, and me particularly on apartment building financing.
Excellent. Daniela, thank you very much for your time. I really appreciate I don't know how to express my gratitude, but
it was a pleasure, Kirill. Always a pleasure to be your guest and to have friends in the industry as professional as you are.
Thank you again. Stay safe, stay healthy. All the best. Thank you.